makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, we'll talk tariffs and markets in a moment with Christian Nolting from Deutsche Bank Private Bank, but we, of course, begin with geopolitics. Now, the U.S. has ordered some embassy staff to depart Baghdad and authorized military service member families to leave the Middle East. That's after Iran threatened to strike American bases if it's attacked over its nuclear program. Now, let's bring in Ross Matheson, our EMEA news director. Now, first of all, Ross, I mean, this kind of came out of nowhere, right? It came from a New York Post. Comments from Donald Trump saying, I don't believe we're making progress with Iran. It seems to have escalated very quickly.
Well, that's right. But what this really is about is where are these nuclear talks between the US and Iran going? For months now, there have been conversations around, is Israel preparing to strike Iran directly and unilaterally? Does it have the capacity to do so? And would it target Iran's nuclear facilities, which would be a major escalation in the region? So we know that those plans have been in the wings for a while and possibly being prepared, but it's colliding with these tensions over the nuclear talks. And we know that from Donald Trump, his perspective is these talks are really bogged down and not going anywhere. We do know for now, Oman said this morning that the next round of talks is at this stage going ahead this weekend, and US officials will be in the region for that. So that possibly creates some breathing space in all of this, because if those talks are going ahead, you can't imagine some kind of strike on Iran is imminent. If those talks get cancelled, that might be a further signal for the market. But the question is there any path forward on those talks? Can we get maybe a trade, dare I say, kind of deal where it's a broad framework on the nuclear front and they push all the hard stuff off? And that at least creates, again, some breathing space. But a lot's going to depend on those talks this weekend. Yeah,
and Ross, just to be clear, I mean, from a historical, point of view, like getting, staff out of embassies is a huge deal.
Well, that's right. I mean, for now, it's contained to Iraq, and they are allowing service personnel's family members in the region to leave if they want. And that's obviously from a heightened sense of concern that action may at some point eventuate. And we're seeing that coincide with warnings again about watching shipping in the area from the naval perspective from several countries. So obviously tensions are pretty high. But we've been here before with Israel and the possibility of a direct strike on Iran's nuclear facilities. Donald Trump has said, many a time he's concerned about such a move and what the ramifications of it might be for striking the nuclear facilities. Also, Israel can't really do it on its own. There's a lot of questions here still. And again, the focus really needs to be on what happens at these talks if they go ahead this weekend, and is there a pathway forward on that?
Domestically, of course, in the U.S., there's still quite a lot going on with the Marines in L.A. Where are we on the protests?
Well, it was pretty peaceful so far overnight in L.A. And again, the curfew is there, but we are seeing some of those protests spread to other cities, New York, Chicago. Also, authorities are saying that they're going to continue these immigration raids for another month. So they're not going to fade off in LA. They're also saying they want federal prosecutors to come in and take over criminal cases from the state. So again, these questions around federal power versus state power, and other states are watching that very closely, and you're seeing expressions of concern there, but you're also seeing these protests kind of start to pick up in other cities. And the question is, what does the White House make of those protests, and do they take action there similar to what they've done in LA? So it's thankfully been pretty quiet overnight, but this is something that's still very much bubbling away.
Ross, thank you so much. As always, Ross Matheson there, our head of our EMEA news direction. Now, President Donald Trump says he intends to send letters to trading partners in the next 1 to 2 weeks, setting unilateral tariff rates ahead of a July 9th deadline to reimpose higher duties on dozens of economies. Well, Trump spoke to reporters in Washington.
Well, we're dealing with Japan, we're dealing with South Korea, we're dealing with a lot of them. We're dealing with about 15 countries, but as you know, we have about 150 plus, and you can't do that. So we're going to be sending letters out in about a week and a half, 2 weeks, to countries, telling them what the deal is, like I did with EU.
Well, we're now joined by Christian Nolting. He's Global Chief Investment Officer at Deutsche Bank Private Bank. Christian, thank you for joining us. There's a lot. There's just a lot to understand, to get through. And certainly on the tariffs, it's unclear whether this is a lever for the timeline, whether he'll go ahead with it, whether it's like a fiscal patch. So how do you see these latest threats?
Yeah, honestly, I'm not so surprised as we are getting closer to the timeline of July 9th that Trump puts some pressure. So if you think of all the negotiations, I think honestly that's to be expected. And I agree, right? Is some deal probably with the UK, there's some deal with China in the negotiations, fine. But the EU deal seems to be very complicated, and there are so many other countries. So that's why I think he puts pressure, because at one point in time he wants to get this done to say I can move ahead with other topics in policy.
But I mean, look, there's a taco trade, Christian, right? Trump always chickens out, or there's, a belief that actually he's putting pressure, but then he, again, doesn't really go quite far. Is it too risky to underestimate that these tariffs will be very punitive going ahead?
Yeah, I think we should never underestimate the tariffs. They will be certainly much, much higher, whatever is the outcome. I think there's a floor of 10%. Then at the beginning of the year, there is a change in the overall setup in tariffs. And eventually we think they are inflationary. So although inflation numbers were okay-ish yesterday, but if I look at Q3, there will be an impact on inflation. And I think the tariff discussion will not end July 9th. Probably EU leads longer. And Trump has also talked about secondary tariffs. I've not heard this for a long time, but that might come back. So I think we will now live for years with that tariff discussion.
What does that mean, again, for when we actually see, that filtering through inflation? I mean, as you say, for the moment, there's bad surveys. It's not really translating into the economy. Certainly inflation isn't. So Is it a 3-6 month lag, or is there a worry that actually the Fed messes this up?
No, I think there is always a lag in this. And I think some companies, because there's so much uncertainty at this point in time, they try to digest this via the margins.
Right.
But at one point in time, when it's clear it stays, then you need to take a decision, right? Mm-hmm. Sometimes it's good to have clarity, to take forward with CapEx. But I think you cannot always say, OK, I take everything in myself. Right. And that's why I think Q3 inflation probably rise to above 3%, by the way, in the US, which is quite a large number.
So what's the ideal way of building a portfolio in these uncertain times?
So, I think what's important is you need to dissect 3 layers. Sorry to say that long. So first of all,
like an onion. I like it.
It's like an onion, indeed. So first you have the political layer, which is a long time period where tariffs might stay forever. Then you have the macroeconomic input. What does it mean? So we say, okay, there's some implications for inflation. That means yields will probably stay at a higher level for quite some time. And then if you look at single markets, sometimes I say markets have a memory of a day, right? So whenever there are companies, different sectors which are doing well, the market will go there. Look at tech, for example, in recent weeks, it all came back in a positive way, right? So, and I think that's the onion, as you say, you need to peel, and that's how you build the portfolios.
So, but do you stay invested no matter what, or actually do you get some dips to actually also go back in?
So, looking back at this year, we said tariffs will probably come in higher than expected, which happened. We made sure it's robust portfolios, but we were underweight on the equity side. But it's never that we say don't stay invested. You need to, I think that's another good example, to stay invested with your asset allocation. But you need to look at regions and sectors. And if you look at the markets right now, equity markets, they are very rational. So look, autos are having a lot of stress. Banks are doing very well. So the market is really differentiating. And I think that's something you need to take into account.
I mean, what do you hedge with? Gold?
We like gold a lot, actually.
Everybody likes gold.
And I know the ECB has already voiced some concern if there's massive movement, there could be something. But I think if you look in terms of currencies, gold is seen then as a currency. Yeah, so we joined that call. But honestly, we were not the last one to get there. For quite some time we are there. So,
Christian, is there something that the market is misunderstanding, or as everyone's looking here, should we be looking elsewhere? I know some of, for example, the trade on Treasury seem very crowded. Is there something that you want to look at differently?
I think in general the market is not euphoric, which I think is positive.
Yeah.
So I would be concerned if the market would be saying, oh, forget about the tariffs. No, everything has come back. Equity markets, sometimes we see maybe they underestimate that there is tariffs coming. Mm-hmm. Fixed income market, I think, is different, right? So yields are higher than before. Right. CDS spreads on the US are higher than before the so-called Liberation Day. So also you need to differentiate. I think equities look from a single sector company perspective. And maybe there's some underestimation of the tariffs there, yes.
Is the bond steepening trade to consensus now?
Probably yes. However, I would say a lot is priced off the steepening of the curve, but the term premium you see is not very high if you compare to history. I think we need to differentiate. The longer end is certainly bound to inflation and growth, where we say growth is coming down, but inflation staying higher, so more sideways. But I do expect central banks to cut. Although we have a quite tough inflationary environment, at least in the US, I would still say they look at growth, and that's why there are some cuts, and that's why there could be some steepening of the curve.
Christian, is there some kind of trade that you were expecting to work this year that hasn't panned out yet because of the noise?
I would say if you look at the equity side, we had a lot of discussion on technology. This has come really back very positively. And I would say, even people don't say, I would think that could continue. Or if there's some correction in the whole market for political reasons, trade reasons, that's where I really say use that buying opportunity. Because I think the market has probably not looked so much where is productivity gains possible. And that's the whole Europe story, is fiscal. But eventually you need to look at the markets where there are some productivity gains. And I think that's where you really need to look. And the market has not started to differentiate there.
Christian, what about the UK? Do you look at the UK, it's a small open economy. It's, of course, not part of the single market. So are there more opportunities in the UK than in Central Europe?
I think what we see right now is maybe that EU and UK are working closer together is probably not so bad, I would say, because it needs a strong Europe, including the UK. I think from tariff, UK are probably better off than the EU. So that's a positive thing. But then you see some people obviously leaving the country. There's a lot of discussion with the clients as well. So I think collaboration makes a lot of sense, and that could deepen. And I think that would be positive for the UK.
Christian, thank you so much. As always, Christian Nolting, their Global Chief Investment Officer at Deutsche Bank Private Bank. Coming up, we're in conversation with the former Italian Prime Minister, Mario Monti. We'll talk trade negotiations, the shifting global geopolitical landscape, and much, much more. That's next, and this is Bloomberg. Now, the Czech president has told Bloomberg he believes his country will adopt the euro, but it will take some time. Petr Pavel has been speaking exclusively to our Kriti Gupta.
This debate has become truly emotional and irrational. My simple argument to our population is that we are dependent on Eurozone, if you like it or not. Most of our trade is with the Eurozone, and in that sense, it doesn't make too much sense when the Eurozone discusses future steps and rules, and we are behind the door. And the sentiments are mostly negative because people were told by a number of politicians that by adopting euro they will become poorer, and everything will be more expensive, and we will have no freedom and autonomy to adjust the courses. But in reality, the room for adjusting courses with our own currency is so narrow that it really doesn't make too much benefit. So sooner or later, I believe that rational reasons will bring us to the adoption of euro, but it will take some time.
Well, that is the Czech President Petr Pavel speaking to Kriti. Now, the U.S. Commerce Secretary Howard Lutnick says the European Union is likely to be among the last deals to be completed. Now, the two sides have been grappling over trade terms before the July 9th cutoff, with the Commerce Chief saying Europe was more than thorny. Well, I'm very pleased to be joined by Mario Monti. He's a former Italian Prime Minister and President of Bocconi University. He's also doing a seminar today on how Europe can become more competitive. Mr. Monti, thank you for joining us, as always. I mean, we had a plan that, another prime minister put it together to be more competitive. Is Europe now, sitting up and taking notice? What can it do in the immediate term to become better?
Yes, this is quite an extraordinary moment for the European Union, both in terms of difficulties given the attitude of the U.S. administration, but it's also a moment when we realize that unless things are done faster, more together, and in a convincing way, Europe has no way. Now, that's why it's also interesting to go back to previous episodes when European Union made a jump ahead. And for example, the single market, of which we discuss so much these days still, was basically launched in the European Council of Milan in 1985, when, for the first time, a European Council under the leadership of Prime Minister Craxi of Italy decided to vote. And Margaret Thatcher was against that. Prime Minister Craxi called the vote. She was outvoted, and so the Intergovernmental Conference started to put together the single market, where majority voting is the key. So we are at a moment when, if we genuinely exploit realistic political possibilities, we can do much more than we believe we can do.
Yeah. But Mr. Monti, is this internally? So is this, structural things? Is it defense spending? Is it just doing some of, the things that was laid out in the Draghi report? Or is it actually looking towards China and further east?
Yes, absolutely. And this is not, Europe has of course been irresponsible over the past years to believe that it could rely forever at low cost on US defense. That was a big mistake, as we see today. But today, I think the public opinion in Europe is ready to realize that putting ourselves in a better position of security is also defending our lives, our values, our social values. And so if the governments are good enough in explaining this, I think the resistance will go down, and it will be possible to do more on defense, also because, frankly, even if, assume that the US president did not ask for Europe to pay more for its defense, but honestly, could we rely forever on the defense basically steered by the US, which is a great country, which saved Europe several times, but which has now a rather erratic and extravagant foreign policy that is not prudent on our part.
But Mr. Monti, how difficult is it also to do this during these trade tensions where, frankly, you don't know whether you're coming and going? There's another deadline. It's unclear whether the U.S. really puts it through. So how much does that complicate things, and what's the right way for Italy and Europe to deal with this?
I think we should calmly consider that the U.S. is temporarily withdrawing from the position of leadership it always held in the international community of liberal democracies and of modern democratic capitalism. There are many countries within and outside the European Union who, on the other hand, want to stick to these values, which are ours and used to be also of the US. So I think we should, for example, take the G7 countries. There are countries there like the four Europeans in a geographical sense, UK, Germany, France, and Italy, but also Canada and Japan. They may wish to, following some suggestions coming from the Canadian government, to set up an alliance of liberal democracies, which might appeal not necessarily to all the EU member states. For example, Hungary would not be interested, but to many non-European countries like Canada, Australia, New Zealand, and hopefully one day the US might be willing to reconsider, to come back into this, and at that point, a new MAGA will be at the order of the day, make America great again, but in a much more real and deep sense.
Mr. Monti, how much does this depend actually on defense spending? Right, and given the negotiations and the talk at NATO, Rome and Italy seems to not have lagging defense spending. Can they really step it up to at least placate some of the tensions at the moment?
The EU as such has indeed appeased some of the tension by relaxing some of the Brussels-made constraints on fiscal policies. But also it's deeply misleading what some governments are doing, namely to present to the electorate the alternative. If we have to do more defense spending, then it is welfare, it is pension, it is the social state that has to give in. This is not necessarily the case. For example, I know several countries, Italy is one of them, where there is still a huge space to go to reduce the tax evasion. That is something that could well go more productively into defense and security spending. Not necessarily, therefore, there is a trade-off between defense and social.
Yeah, Mr. Monti, if there's one thing that you would, prioritize as former commissioner, as former Italian prime minister right now for Europe, just one, what would that be?
To have the Commission and the President of the European Council to rein in some excessive nationalism that is there, that is really. Take the Draghi report, an excellent report outlining what Europe should do to become more competitive and productive. Okay, all governments paid lip service to this. No government is ready to take it seriously. And they continue to say, Europe, wake up, meaning Brussels, the Commission. But in fact, most of the obstacles that still exist to a unified single market are in the hands of the member states. Look at what is happening concerning the dynamic in the banking system with Unicredit and Commerzbank, but also in Italy. Well, all those defensive actions that are taken to preserve essentially political power by some governments are completely against the single market, the Draghi report proposals, etc. So we need to reduce the degree of hypocrisy if we want to make Europe more effective.
Mr. Monti, thank you so much. Always straight to the point with the former Italian Prime Minister and President of Bocconi. Coming up, oil spiking on heightened tensions in the Middle East. We'll talk with Michele Della Vigna from Goldman. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil jumps as the U.S. orders some of its embassy staff in Iraq to leave after Iran threatens to strike American bases in the Middle East. Now, the clock is ticking. Donald Trump threatens to set unilateral tariffs again within 2 weeks, ahead of the end of the 90-day pause next month. Plus, downtown L.A. under curfew for a second night as the U.S. president escalates his immigration crackdown. Now, oil has edged lower after jumping more than 4% yesterday after the U.S. ordered some of its embassy staff in Iraq to leave. It follows a threat by Iran to strike American bases in the region if nuclear talks collapse. Well, Kennedy, Bloomberg senior executive editor for energy and commodities, joins us now. So, first of all, let's take a deep breath and understand exactly what's going on. What's the factor pushing up these prices? Iran said, look, if you touch my nuclear program, we'll retaliate, but we don't really know where we are.
No, but clearly there's been a lot of speculation about which way these negotiations between Iran and the United States might go, and it's absolutely vital to the oil market because if they collapse, it's clear that outside the threat of any military action, there will be more sanctions on Iranian oil from the US, so it will take barrels out of the market. So clearly the market is very sensible, to the threat of military action in the US and in Iran, and what that might do to exports out of the Gulf, but also just that there could be more US pressure on Iranian exports, and that could take barrels out of the market, which is why we've seen the significant rally that we saw yesterday.
Well, we're just getting some breaking news, some headlines crossing the Bloomberg terminal from NOR, which is Iran's semi-official, government agency. And they're basically saying, first of all, that they're launching a new uranium enrichment center. That doesn't seem like great news. And then they're also calling for censure by UN nuclear watchdog as political. So, again, is this talking to a domestic audience, or does it feel like it's really escalating?
I think probably both of those things. Clearly, they want to look like they're strong in this situation to people inside Iran. But again, it speaks to the fact that clearly we don't seem right now, judging by the rhetoric coming in from both sides, to be on the cusp of a deal, even though talks are scheduled to continue, I think, this weekend. And that's making the oil market nervous.
What does this tell us actually about also the heightened state of the markets?
Yeah, it's really interesting where oil is right now. I think the salient fact, the thing that I would point people to is that yesterday we saw Brent hit more than $70. Now, that's a price that we haven't seen since before OPEC started making these oversized production increases back in April. And it's really interesting that OPEC's been able to put all this oil back into the market, yet prices have actually rallied in recent weeks. And we know that the Saudis would like to put even more oil in. So I really think that speaks to, A, the underlying strength perhaps of oil demand, but also the fact that the market is very worried about what may happen in Iran.
Well, thank you so much. Will Kennedy there with the very latest, of course, on oil and those breaking news from Iran. Now we're joined by Michele Della, head of EMEA Natural Resource Research at Goldman Sachs. Michele, thank you for joining us. What do you see as the most imminent threat, actually, to the price of oil and energy sources?
Pleasure, Francine. I think it's a difficult oil market that we're in, because on one side we are going into peak seasonal demand with strong geopolitical risk and inventories at a low level. This is why I think we continue to see the oil prices spike on this news. But if we take the luxury of looking out 3-4 months, as we look to October, November, we are going to have the inventory impact of all of the OPEC increases, which we haven't seen yet in inventories. We are going to get a low in seasonal demand. We will continue to see non-OPEC growth, because one of the things we observe is that so many big projects are ramping up. All of the projects that had investment decision pre-COVID were delayed are now coming on stream. It's like the last hurrah for a lot of countries from a production perspective. And we think that builds up a very, very bearish outlook for oil as we look into autumn.
Yeah, Michele, what's very bearish? Is there a kind of level to which a lot of the Gulf nations will have to do something about it?
I think absolutely. I think if we cross down below $60 per barrel and we approach 50, we think that is the level where OPEC will most likely pause the production increases. And this brings us back to one of the problems we're seeing at the moment, which is circularity. So as long as oil remains in the high 60s, it's giving a clear incentive to OPEC to continue to go for production increases and market share. So most likely they will do another 400,000 barrels per day increase in August. And we will only see that in the October inventories. And by the time that happens, it will be seasonal low in demand. The inventories will build very quickly, and I think the price reaction will be quite abrupt.
Michele, talk to me a little bit about what it means for LNG, for example. I mean, can LNG, pick up some of that, do prices, some of them are linked, for example, in Qatar with the price of oil. Does LNG also suffer on the back of it?
Without any doubt. And LNG has an added dynamic to it, which is an avalanche of production coming, really starting from this year, but continuing for 5 years in a row with projects that have been committed and are already under construction. I mean, another read across from LNG is that, especially in 3 countries, the US, Qatar, and Saudi, the increase in gas production is coming with a lot of liquids associated NGLs, which effectively for all purposes are oil equivalent. This by itself will grow liquids production by close to 500,000 barrels per day each year for the next 5 years. And that is independent of oil prices. That's, I think, another bearish driver for oil, and another thing that links the bearish view on LNG with the bearish view on oil on a 6 to 12 month basis.
Michele, talk to me a little bit about, ESG funds. I know you've argued in the past that actually energy companies that lead the energy transition should be a cornerstone of ESG funds and not seen as a hindrance or certainly not a divestment target. Has the space on that changed?
No, I think too little has changed there. We are strong believers that we need more energy on all fronts, that oil demand will grow to the mid-2030s, gas demand will grow all the way to 2050. But in the meantime, renewable production is also growing fast, and we need companies who can manage risk for intermittency and seasonality. So I think the traditional integrated oil and gas companies that are really becoming energy companies, I think should be a cornerstone of any investor's portfolio. Now, it may be difficult to own them if they share our view that oil may go down towards $50 per barrel in the next 3 months, but that actually could be an amazing buying opportunity for these companies that are growing their business both in traditional energy and in some cases very successful in low carbon and renewable energy as well.
Michele, how do you see also the situation in China? We talk a lot about, these tensions, these tariffs, and the fact that it's really pitting the U.S. against China. I mean, China had done quite a lot on energy transition. Does it double down given what's happening in terms of U.S. policies, or does it go the same way?
I think they're doubling down. And this is not because of energy transition. This is because of energy security. They're doubling down on everything they can produce domestically, and that is batteries and solar for renewables and electrification, and that is coal for power generation. It doesn't really lead to a material decarbonization, unfortunately, but it certainly leads to a much safer energy production for them. And that's why I think they keep doubling down. And if the U.S. no longer imports some of their clean tech equipment, I think they will keep exporting it to the rest of the world, including Europe.
Michele, talk to me a little bit about Europe and actually energy security. I know there's a lot of talk, and I was speaking with Mario Monti about the fact that maybe there's not that much money in terms of defense spending, or certainly not as much as the U.S. wants. But where are they on energy security? How is Europe doing?
So let me give you one good news and one question mark. So I think the good news is this avalanche of LNG that is coming on the market, I think is going to be brilliant for Europe. It is going to lead to gas prices, which in 2 years' time, we think will be 50-60% below where they are today. What good news. That's the energy crisis resolved. That's European heavy industry becoming competitive again. That is brilliant. The question mark is on tariffs, because at the moment Europe has barely any tariffs on imports, for instance, on clean tech from China, and therefore on batteries, on solar panels, and increasingly on biofuels and wind. It's entirely dependent on imports. I think there is a serious question mark here as to whether that is the right industrial policy, or whether Europe should think about tariffs again. We've done a Carbonomics report focused on that, where we look at what tariffs would make local production of this clean tech competitive with China, and clearly that would require a big change in industrial policy.
So interesting, Michele. Thank you so much, as always. Just great insights. Michele Della Vigna, they're head of EMEA Natural Resources Research at Goldman Sachs. Now, parts of downtown LA are currently under a second night of curfew as the Trump administration escalates its crackdown on U.S. protests over immigration raids. Charlie Wells is here with a deeper dive. Hi, Charlie. So what, first of all, is the likelihood that these protests continue, but also really spread?
Yeah, Francine, so the conditions really are there for an escalation. And I think there's sort of two factors to keep in mind here. I think one is just this ramping up of these ICE raids across the country. So officials have been talking about how these could continue daily for the next month. So you have that kind of enforcement change. But on the other hand, you have this huge demographic issue. And I think looking from outside the U.S. in, there are 11 million undocumented people in the United States. So you have this huge population, and you have these ICE raids targeting workplaces where a lot of these people go to look for jobs. That's got an emotional element, it's got a demographic element, and it's got this kind of policy change element. So I think this really could continue if people aren't careful.
Yeah, so how is the Trump administration responding? Is it escalating?
They're really doubling down. And I think they really are doubling down in this idea of federal power. So you see this deployment of active duty military troops on patrol in Los Angeles. And, you know, a spokesperson for the Pentagon yesterday was saying that there are now more active duty military personnel in Los Angeles than there are on duty in Syria or Iraq. You also see the Trump administration really kind of in the realm of law enforcement, bringing up this idea of a more expansive federal power. So the Attorney General Pam Bondi yesterday was talking about invoking the Hobbs Act. So this allows federal prosecutors to take over criminal cases that would normally be handled at that local level.
Charlie, a hearing over the deployment of troops in LA is scheduled at a federal court today. I mean, what are the dynamics of that case? We also seen really Gavin Newsom double down and fight back.
Right. So this is a lawsuit that Gavin Newsom and the state of California filed on Monday. And it really is about this issue of sort of states' rights versus the federal government. And it's striking because you usually would hear conservatives talk about states' rights. But here you're hearing a Democrat talk about states' rights and about how California alleges Trump has kind of overstepped executive power in deploying these troops on a domestic level. Now, the Department of Justice filed yesterday saying that Trump is within his right to call up the Marines, to call up the National Guard. But this is a question really that this judge later today is going to have to weigh very heavily.
Yeah, and this is a big deal. Charlie, as always, thank you so much. Charlie Wells there with the very latest on LA. Now, some other stories making news today, and there are fresh signs that the UK could be on course for the biggest exodus of wealth in the country's recent history. Now, a Bloomberg analysis of 5 million company filings shows a spike in business leaders leaving. More than 4,400 disclosed an overseas move in the last year, up around 20% on previous years. Apollo Global Management will not recruit investment banking candidates from the class of 2027 this year. Now, this decision comes after a backlash from banks like JP Chase, which are concerned about junior recruits accepting future job offers too early. Apollo now says this early recruitment process is not beneficial for students or the industry. And the chief executive officer of Double Line Capital, Jeffrey Gundlach, believes America's debt burden and interest expenses have just become untenable and may lead investors to move out of dollar-based assets. Well, he spoke to us exclusively at the Bloomberg Global Credit Forum in Los Angeles.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
Double Line Capital Chief Executive Jeffrey Gundlach speaking to Bloomberg. Now, coming up, tech founders, investors, chief executives, and government officials gather at Founders Forum here in the UK. We'll take you there shortly for an exclusive interview with the chief executive of the AI avatar platform Synthesia. That's next, and this is Bloomberg.
We can't let Shanghai and San Francisco have all the fun. I think Londoners are going to really embrace autonomous vehicles and a robotaxi offering. There's such a rich diversity of different mobility offerings in London, and I think bringing the benefits of autonomy here is so exciting. We've been working on Wave for about 8 years now, and the opportunity to now bring autonomous robotaxis to a market like London, which I think is one of Uber's 5 biggest markets, it's a dream for us. So I'm really excited for this opportunity.
Well, that was the chief executive and co-founder of the autonomous driving startup Wave, speaking to Tom McKenzie earlier about his partnership with Uber to trial driverless cars in London. Finally. Now, the Wave chief executive is among the founders and tech investors attending the annual Founders Forum in England's Oxfordshire. Now, this year, Bloomberg and Founders Forum have also combined forces to highlight the European companies and their leaders aiming to have an impact on a global scale. Let's bring in Tom McKenzie, who's with the chief executive of one of our 25 startups to watch. Tom, over to you.
Fran, thank you very much indeed. Yes, pleased to say I'm joined now by the CEO and co-founder of Synthesia, Victor Riparbelli. It's a London-based but global business focused on reshaping the video platform using artificial intelligence with avatars, with a big focus on the enterprise space, and they've seen a lot of growth there. It's another red-hot European startup. Victor, thank you for joining us. We had Jensen Huang, of course, in London and then in Paris talking about the infrastructure needs. You have recently trained your video model on NVIDIA's latest GPUs, the Blackwell, the most sophisticated AI accelerators. You're the first company to have done this. What did you learn? What is it enabling you and Synthesia to do for your customers?
It's very simple, right? It's just much, much more effective. So we're seeing up to like 40 to 70% cost savings on training and inference. And that's massive, right? Those are, of course, things that go back into lowering the prices to serve our models for our customers and also delivering even more capable models at lower prices, right? And right now in AI land, margins is the talk of the town. The products are great, they work, but they're much more expensive to serve than the kind of SaaS era, right? So any kind of improvement we see in efficiency on kind of like at the chip layer has a massive impact on the industry.
Okay, margins are the talk of the town. Efficiency is in focus. Jensen Huang talking about the needs of infrastructure in Europe, continental Europe, and in the UK. Is infrastructure a bottleneck for a fast-growing company like yours?
I wouldn't say it's a bottleneck for someone like us. We don't need in the millions of GPUs. I think it's very important for Europe strategically that we have data centers, that we can train big models regionally. But I wouldn't say from a practical perspective that it's something that I think a lot about in kind of my everyday.
And you have that partnership, of course, with NVIDIA, one of your backers.
Exactly.
As you continue to innovate your models and your offerings for your enterprise clients, what are you able to give them? How are they adopting this and integrating into their businesses? Because we still need to ask about the return on investment for enterprises. Are you starting to see clear evidence from your clients that is starting to happen for them as they adopt your services?
Oh, massively. So we've been in market now for 5 years with our AI video platform built for the enterprise, helping our customers communicate more effectively in video. And we're seeing cost savings and productivity engagement gains all over the place. Wise, for example, another great UK startup, seen a 20% reduction in production costs for all of their content, right? That's a pretty big line item where you're at a scale like Wise is. And that's something we see repeated across many other companies in the enterprise. UBS, one of the world's large investment banks, they just implemented AI videos as part of the research that they do. So instead of you receiving text-driven research as a customer, you now receive video, which has also been received incredibly well by their customers. So I think we are just seeing this big shift, right, from reading things to watching and listening, and we're powering that shift for so many of our customers.
Are you seeing use cases that you hadn't imagined as your clients adopt this technology?
Absolutely. So when we built the platform, it's very important to me and the team that we build a platform that's open, accessible. You can go in, you can kind of do whatever you want, right? We didn't want to be too prescriptive on what you should do. And I think that's really paid off. We have millions of users that every day experiment. Some of the things they do work, some of the things don't work. But there's a lot of, I think, one of the most amazing things about this generative AI era, with Synthesia, ChatGPT, all these tools are so easy to use, they're so accessible, and that just breeds this very, very quick iterations on new use cases. And that's very different from the AI era of 2018, 19, where if you wanted to do an AI project, that would be 12 months later, maybe you'd have a result after you've collected the data, trained the models on what's working. And I think that's also why this space is moving so fast, because the speed of iteration, not just on a company level and how quickly I can build new products, but also how quickly my customers can take those products and figure out where they work. It's just a phenomenal combination.
And you guys at Synthesia, you hit this important milestone, revenues of 100 million in terms of ARR for last year, $100 million. What do the revenue streams look like for 2025? The macro environment is a little bit more challenging. Are you seeing that pace of demand and pace of growth and uptake?
We're actually not seeing that. The business is accelerating quite significantly over the last 6 months since we raised our last fund round to Series D. I think there are some macro implications. All the tariff talk, of course, I think for physical goods obviously has an impact. I think with digital goods we haven't really seen it yet. Maybe there's more fear in the market, but I think the underlying thing here is that the wave of AI productivity and the kind of economic opportunity of building an AI massively dwarfs these kind of smaller spikes in the macro environment. So I think for AI companies that are growing really fast, it's very clear that everyone on the planet, every business on the planet, know that they need to adopt AI, and so they are very willing to put budget aside, because I think most companies feel, and I think rightly so, that if they don't adopt AI quickly enough, right, they will be put under a lot of competitive pressure.
What does that mean for the stickiness of your clients and their contracts? Are they signing 12 months and then rolling over? What is that picture for you?
So we're signing multi-year contracts. Our NR is going up and to the right, and that's driven by, of course, our customers being very happy with the product, but it's also very much driven by expansions. What we're seeing is that usually we'll have like one team, they'll come in, they'll find a use case for Synthesia, and then their colleagues will see it, they'll begin to adopt it, other people will adopt it, and that's how we go from contracts with, Fortune 100 companies that may, 3 years ago was $30,000 a year, which is very small in enterprise context, and now it's like $1.5 million. So that's the thing we're really seeing in the enterprise. We're able to go and make one team successful. Some of them even start on self-service plans, just putting down their credit card and starting to create content. And then they slowly ramp up their usage and become really big customers and really just integrate AI video into everything that they do.
What is your biggest growth market right now, regionally?
The US is our biggest market, but we are a very global company. The platform works in 140 different languages, so we very naturally have big presence in Japan, big presence in Europe. The language barrier is a huge problem for our customers that are global, and we really help them break that down.
Can the UK hold on to Synthesia? You were born and bred in London. You're a multinational team, of course. You are a global enterprise. You're in Series D, so you're getting towards a point where questions will be asked about IPOs, Victor. Is that going to happen in the UK, given the current environment?
So, we're roughly 500 people now, right? So we're a pretty sizable company. We've decided to stay in the UK. I'm personally very passionate about making Europe, a great region to build companies in, and I think we need to build global leaders from here. So that's definitely our ambition to stay here, right? But there's also no denying that when you look at where to listing in Europe and in London, for that matter, it's not very attractive.
It's not very attractive right now. What would they need to do in the UK to change that dynamic and to make you rethink a listing in the UK?
I think there's some simple things like the transaction fee on the London Stock Exchange, for example, that can probably be done better. There's, liquidity problems. How much do pension funds invest in growth stocks, for example, right? That's looking very different in Europe than it does in the US. There's a bunch of structural things that can change. It's not something you can do overnight, but I think if we really want to compete on the global stage, then we also need, an exchange that really can support that. I don't feel like there's any exchange in Europe that does that today.
No exchange in Europe that does that. Just very briefly, Victor, is this a wake-up moment for Europe in terms of the tech ecosystem?
For sure. And I think it is embarrassing that it took this much macro-political tension for us in Europe to take our defense seriously, to take our tech industry seriously. I'm very happy that it's happening now, and I think everyone is waking up and figuring out that maybe instead of just regulating things, we should, help builders build great companies. We should have a defense that can take care of us. So I think it's good that it's happening. I wish it would have happened 5 years ago. That would have put all of us in a better position. Mm-hmm. But now that we're here, I think it's good, and there's tons of momentum.
Embarrassing, even as it is a wake-up call, and maybe there's that momentum and opportunity going forward. Victor Riparbelli, CEO and co-founder of Synthesia, on the developments around the training of NVIDIA and the push further into the enterprise space around that AI video platform. Back to you, Fran.
All right, Tom, thank you so much. Tom McKenzie there at Founders Forum. Now, also, don't miss the launch of our new monthly show, Bloomberg Tech Europe, and that starts tomorrow at 6:30 a.m. London time. Now, we're just getting some breaking news. An Air India flight carrying 242 passengers on board crashed near Ahmedabad city in the western Indian state of Gujarat. That's according to ANI. They are reporting, actually, local police. We don't know exactly what type of plane that was or the reason for that. We'll keep a very close eye on it. But just latest, this plane has crashed at Ahmedabad airport in India. This is Bloomberg.